and I will talk to you soon.
Hey everybody, this is John, and welcome to the premium video. So let's dive in here and take a look-see at everything that's going on. So from a daily chart perspective, the S&P's had a very normal pullback here after four huge days of gains. We had a minor pullback to the 8 EMA. Okay. Now, from how the 30-minute chart here closed with a 30-minute squeeze here, it actually is pointing to more downside. Tonight, I'd expect at least a test of the overnight lows. I think we could probably get to the 21 EMA, which can also see lines up with that 50% retracement level at that 2750 level. So we'll see. Tomorrow is certainly going to be interesting. If we take a look at the VIX, last night talked a little bit about, hey, let's look for the VIX to kind of revert back to the mean. We did, so the question is that all we got? I think we got another thrust higher here. I don't think actually we're going to get up here. Remember, we do have a massive 2-day squeeze forming, but I am looking for a little bit more upside in the VIX. Right now, that's my main hedge. And then from there, my main hedge is puts on SMH on the semis, and this one's working out pretty much as planned. We did kind of come back to the mean, and then today rolled over hard, and you can see down really got clocked, and it was a horrible close. So, again, at this point, I'm not looking for these to take out the lows. Of course, anything could happen. But I am looking for a little bit more weakness before things turn around. The put-call ratio, the 10-day moving average of the put-call ratio continues to climb. Remember, as it climbs up here, that's bullish, and once it gets over 1, that's super bullish. Okay, you can see here when it gets over 1 here, it's kind of like it lines up with the bottom. Here, it almost got to 1, lines up with the bottom. So we're not there yet, but main thing here is that this is a buyable dip is what I'm trying to say. So, we're looking at the markets here, and I want to buy the dip. And for me, when I say buy the dip, to me, from a daily perspective, that is the 21 period moving average on a daily chart. If I can get that, that's my favorite dip to buy. Also, you can see here, if we look at the 30-minute chart on the NASDAQ, also a horribly bearish pattern here. This is just about the nastiest ledge slash head and shoulders. So I can't imagine that we're not going to test the lows tomorrow. Of course, as we all know, anything can happen. Now, that being said, there are stocks out there that are holding up just fine. Thank you very much. It's actually a testament to, you can see how weak actually the NASDAQ is if it's down 47 points, but stocks like Netflix are up, stocks like Amazon are up. So you can see how much weakness is actually coming out of the semiconductors. So on the 30-minute chart, there's a beautiful squeeze here in the room today, and everybody's laughing like, "Oh my God, you got to buy this." I love this setup, but again, what I'm looking at is, gosh, if the NASDAQ flushes, could we get another opportunity to buy this again down here? So I'm being a little chicken, which I know is um, not usual, right? But it's like I love it when you get those little like those flushes like that, and you can just kind of pick it up. And if I miss it, I miss it. So then that's fine. And then if we look today, point of control. I mean, the point of control just kind of owned the markets today. For those of you that aren't familiar with this, the idea with this is the daily point of control, this is the weekly, and it just shows you where the most volume is taking place. And of course, all the electronic markets and things like that are just kind of attracted to that because that's where all the transactions take place. And we just couldn't get that far away from it. So even here, when it looked like the markets were going to go, we got sucked back to that weekly point of control. And let's take a look real quick. Let's take a look here at Amazon. I mean, look, Amazon and Netflix act freaking great. Okay, I wish I had Amazon. I don't. But I tell you, if for some reason it gaps down tomorrow, I will be a buyer. I watched it this morning. It actually was trading lower pre-market, but by the time the markets opened, it was actually regained everything. So from an options perspective, you couldn't do anything. If you were buying the stock, you certainly could grab it. Some of the, kind of not, and although it shouldn't really be tariff related, the BABA here, you can see having a tough time. So some of these stocks here that are having these fantastic rallies right into resistance, kind of getting clocked. And then I do want to take a look at some of the other asset classes here, just real quick, and kind of get a sense of, what happened today. And the main thing here is, first of all, dollar went bid, all right. And I think this is tariff related. I'm not expecting the dollar to explode higher from here, although stranger things can happen. But keep in mind that we have been talking about cycle highs in crude oil, and crude oil got plastered today. Okay, that's what a cycle high looks like. I am not expecting crude oil to recover from this. So this is not a dip I'm buying, because you had a sell-off like this on high volume. This typically means you're going to get more follow-through to the downside. And then if we look at, that's not what I wanted to look at. If we look at bonds and notes here, you can see from a daily perspective, well, let's actually look at bonds because I've got those kind of mapped out here. If we look at the daily perspective here, I mean, let's actually, I want to put this on a weekly chart. So from a week, there's the trend line. That's the trend line I was looking for. So from a weekly perspective, you can see that, yes, right now you've got, it's kind of bullish right now, but from a weekly perspective, it's very normal to come back up and test this trend line. So at this point, what I'm looking for in terms of a continuing rise of interest rates, which means lower, prices in bonds, from a long-term perspective, is still fully in play. All right, what about other stocks here? So the stocks I like, we were talking about this in the room. I mean, there are stocks in a market like this, when the market is sloppy. Okay, here's how I like to structure my portfolio. I generally go 80% cash, and I'll tell you why here in a second. And then with the remaining 20%, I do hedges. So in this case, I'm long VIX, and I've got puts on SMH. And then I'll do calls on, like, say, Honey Badger stocks. And Honey Badger stocks, of course, Amazon, Netflix. We added today calls on EA for a run into earnings, and Shopify, which is not only earnings, but you got an IPO. Okay, so that's great. So why stay 80% cash? The 80% cash is I look for, what I can just call bigger opportunities. That day that you can load up on Amazon on a gap to support, and when you get a trigger buy, Amazon can run 20 points in a day. You only need to do one of those a month, right, to have a great month. That's why I leave so much cash available. So that's the kind of stuff I want to be prepared for. I don't want to be fully loaded and I'm long, 100% long, and the next day the market's gapped down and I have no cash, right, to buy anything. And of course, I don't mean to, say like, just buy the dip. It also means like looking for short opportunities too. But we all know this market has just been cruising and cruising and cruising. If we look at so let's look at, I think I said Shopify, but I meant Spotify. So Spotify is an IPO. If you guys know, it's the music service. It doesn't have much here on a weekly chart, but it does have a daily, I believe, a daily squeeze coming up and earnings in a couple of weeks. So today, bought some slightly out of the money calls with the expectation of a rise of implied volatility and price into earnings accompanied by a squeeze. I love this setup. This to me is an easy setup. Does it mean 100% it's going to work? Of course not. But the probabilities in this trade are really good, and that's what I like about it. And another one I like here that I don't have is SFIX. Again, another kind of a newer stock IPO. I love this 30-minute squeeze. I don't have this one. I probably actually wouldn't even buy the options on this. I'd buy the stock, and this is one that I will look at for tomorrow. All right. From there, I'm also kind of prepping up my portfolio. Just so you guys know, I got my last kind of trip of the summer coming up, family trip, where we're going to be gone for a couple of weeks, going to fly to Paris, go to Kenya, and go to Romania, and then go to I'm going to say this right, Avignon. And this is going to be a long kind of a family trip, multiple weeks. And so I am going to set up some trades, but I'm not, I'm just going to set them up, kind of a set it and forget it, where I risk the debit paid, and then I have an order. It's a good till cancel order to get out. And on something like this, typically like XLF, we bought this for 48 cents. It's a strangle, and I've got a good till cancel order on it for $1. These are August. This is not something that I'm going to be worried about or checking while I'm traveling. This is an easy kind of a trade. And so the same thing with these earnings trades I'm putting on, like for EA and Spotify. The idea is that I'm going to put on good till cancel targets, risk the debit paid, and then I know what day the earnings are, so I can just check check in or have Henry check in and say, okay, look, if my target isn't hit, then just get out. Obviously, there's going to still be some premium there because the implied volatility is going to rise into earnings, right? But I'm not going to hold through earnings. So what I like about trades like that is they're very definitive. You don't have to watch them. You're not worried about, you're going to position size it for your risking the debit paid, and then from there you're not going to worry about it too much. So as an example, it's kind of like let your orders, let the market do the work for you. So as an example on that, on EA, right? So I've got this on EA, and so we bought this at 358 today. It's at 392, and my exit on it is $6.25, right? So I'm not looking to, I'm looking for a decent return, but I'm doing something purposely conservative since I'm not going to be able to watch it, right? And you can see we got the 16-day out options. Yeah, the implied volatility is high at 47%, but it's going to keep increasing. So if the stock trades flat, we'll actually be able to hold on to our premium. And then the other one here is Spotify. Yes. So same thing here. Earnings the same week as Electronic Arts. I've got an order, a sell order on this at $9.25. Again, I'm not looking to, I'm not looking for a 3-bagger or a 5-bagger. I'm just looking for a decent return. I'm willing to risk the debit paid, so I don't have to stare at it. And if the day that earnings are coming out, if my target doesn't hit, I'll just get out. I mean, there's going to be something there, right? It's not going to be worthless. Hopefully, it's worth more than I paid, but I've got a conservative target on it. So hopefully that all makes sense. And take a quick look at some Fibonacci's. All right, for those of you that are not aware, we've got a very cool Fibonacci-related course going on right now. It's going to be broken up into a couple of different packages. For the one that we're going to be doing tomorrow,